Welcome to Checks and Balances. I'm Michael Vincent. This is James Blair. And this week, conservative funds are dropping more than growth funds. What is going on?
Okay, so 2021 as a year. Interest rates record lows, share market through the roof. Those smooth brain apes with crypto were going gangbusters.
Haven't heard from them in a while.
The share market just moving at really big paces. Everyone with their Sharesies account very happy. 2022, you've seen interest rates double, post-pandemic hangover, wars going on, the share market dropping. House prices is an interesting one. You know, it's starting to teeter a little bit, Mike, down 0.9% over a quarter. The S&P 500, which is the top 500 companies in the US, that's down 15%. The NZX 50, top 50 companies in New Zealand, down 13%.
Oh my God, we lost $50 of market cap.
Bitcoin has halved in value. Zero is down 40%. Rocket Lab's down 62% since inception. Mike.
They did catch a rocket with a helicopter. Like, what else do you need to do?
What do you want, markets? What do you want them to do to give them a fair valuation? That probably links quite nicely to KiwiSaver as well. Yeah. So that's probably the kind of closest investment to home for most Kiwis is KiwiSavers have dropped 1 to 8%.
Yeah.
Now, the really interesting thing there is usually the story is, hey, if you want to invest into a growth fund, you know, you might get an 8% return on average, but in a global financial crisis, it can drop 30%. A conservative fund, you might get a 4 or 5% return, but it'll only drop 5%.
Yeah.
The interesting thing, Mike, is that has not happened. So Simplicity, as an example, their conservative fund has dropped 6.58% in the last 12 months. This is from May 2022. Their growth fund has only dropped 3.88%. So we're going to talk about Simplicity in particular in terms of why are we bringing them up? Because they've got a couple of things where you kind of go, what's the story there? But in generally speaking, this is the market as a whole, is that the conservative funds have dropped more than growth funds, which is very unusual.
Yeah, and generally speaking, you know, when we're giving advice to people, when we do their risk profiles and we're looking at what they should invest into and these sorts of things, we ask them, you know, like, what could you sustain and what fund should be right for you? What loss could you sustain? What would you be comfortable with? What type of fund is right for you? And if someone said, oh, look, you know, I'm a bit more conservative. I want something that isn't going to drop as much, you know, when the market's down. We would go, hey, don't go growth, go conservative. Not the case.
Not the case. So the obvious question is why? Why has this happened? Why have conservative funds dropped more than growth funds? The answer is interest rates. So firstly, we should probably talk about what is in a conservative fund. So growth funds, mainly shares.
Yep.
Conservative funds, mainly bonds. So firstly, we should probably explain real quick what a bond is. So you're investing into a share, you own a percentage of the company.
Yep.
You know, the performance could go to zero, could go to the moon, somewhere in between. A bond is a debt instrument. So instead of owning a part of a company, it's going, say Mike's a company, and Mike's like, I'd like $100,000. I'd be like, well, Mike, I'll give you $100,000, but I want a 2% return on my money each year for the next 10 years, and then I want my money back at the end.
Yeah.
So you're not the same as if the company fell over or the value of the asset drops as much.
Bond nerds make that sound so complicated with coupons and this and that. It is a really simple thing.
Yeah. That's right, revolving credit. So a bond, get paid a percentage each year, and interest rate, get your money back at the end.
Yeah.
What's changed and why conservative funds have felt the pinch so much is a 2% interest rate. It wasn't bad a year ago. Now you're in a fixed agreement with that bond. You can now get 4 or 5% out in the market. You look at that 2%, go, I don't want that.
Yeah.
So that has made the value of the bonds drop, which has made conservative funds drop more than the growth funds.
Yeah, and there was some crazy bond durations coming out when interest rates were super low as well.
Yeah, that is very true. So Simplicity in particular. So Simplicity as a provider, they're all about passive. I think they might even be defined as, they're definitely a non-for-profit. Now, Simplicity, their whole approach is, hey, we'll keep the fees really, really low, which is a great thing. The government loves it with default providers, all that kind of good stuff. The problem is that there's no management really of the portfolios themselves. There'll be some kind of structure in terms of how the portfolios are brought together, but where they've fallen over is the duration of these bonds. So say, for example, Lighthouse, with our relationship with my fiduciary, last year we flagged interest rates were increasing. We reduced the durations on the bonds within our portfolio. Why duration is important is if you have a smaller period which the bond takes to mature, you feel less of the pinch of interest rate movements.
Yep.
But if you fix for 20 years, 2% for 20 years opposed to 5%, it's a very long time to wait. So Simplicity has got longer durations on their bond portfolios, which has meant they have felt much more of a pinch on their conservative fund than, say, Milford or a Lighthouse model portfolio. Milford's conservative portfolio dropped about 3% so about half due to that active management piece.
Yep.
There's a lot of chat out there in terms of, active managers. And it is true, statistically, very hard to outperform the market after fees over a long period of time. But I think a really good shout that's not a one-size-fits-all, it's not a blanket approach. Simplicity definitely has some questions to answer in terms of the durations of those bonds. How has that all played out? The other thing in terms of Simplicity's KiwiSaver funds and their funds in general is how they manage their overseas assets and some tax leakage. So you might have a really low management fee, but you might be paying more in tax, which ends up still being less money in your pocket.
Yep, cool. So look, I think what the punters want to know, what are the learnings here, James?
So the first one is low fees does not mean necessarily good. Fees are important, but it is one of many parts of the decision you make. So fees are important because it means less money in your pocket, but there are other factors to take into consideration as well. I don't expect you to think about the duration in your bond portfolio.
Bit unfair.
But during periods like now, seeing how providers performed is important.
Yeah.
The second thing is, and this is for the first home buyers, which I know you can probably talk about, Mike. If you had your money sitting in a conservative fund, that's not a fun exercise you've just been through.
Yeah, absolutely not. So think about cash funds. If you're going to be buying a house and want to use that KiwiSaver as your deposit for your first home in the next 12 months. Yep, almost no return, but you're not going to lose money if the market drops, or you lose a lot less.
Yeah. Two other points to keep into consideration. Conservative funds can still be volatile. You've still got money in assets outside of cash, so there can still be volatility. So that's important to take into consideration. And alluding to the same sort of point as the buying of the first home, you got to think about your time frame to invest as well when picking a fund.
Yep.
So we'll wrap it up right there. Please make sure to subscribe, give us a review. We'll catch you next week.
Cheers.